Well, greetings, my beloved clients and friends. Just wanted to do a follow-up video to the last one where we talked about investment strategy, and we talked about one of our philosophies here at Platinum is a buy and hold strategy. And probably the masters of that was Warren Buffett and Charlie Munger. And that was their strategy and is their strategy at Berkshire Hathaway. They, in the last 50 years, they've really gotten good since the mid 70s. So yeah, about 50 years. They've gotten really good at identifying great companies that they could hold on to for decades. Okay, and we studied them extensively because it's a great strategy. It's very time efficient, cost efficient, tax efficient, and you could do it with just a few people. I mean, they run this great company as basically the two of them. They have a couple managers now, and they've done very well for their clients over the last 50 years. They've gotten great returns. I guess their one problem is that they have too much money, so it limits their pool of investments that they could invest in because they have too much money, right? Just putting $1 million wouldn't do anything. When they write checks, they need to write checks in the billions. And he's even said, Buffett has said, man, if I only had $100 million, I could probably get 50% returns. Now, that's never been proven, so, he's never tried it, but that was his thesis. But anyways, so I wanted to talk about that strategy. And one thing that I was listening to a speech on Charlie Munger, and he said something very insightful. And he was talking about thinking, but the example he gave was so insightful into their investment strategy. He said that they bought this furniture store, and it was the biggest furniture store in the country, and they just had one location, which happened to be in Omaha, which was their hometown. And the numbers that they were doing out of this one store were just insane. So he said, how would we think about that? And without knowing a lot about that company, he started to ask a few questions just by looking at the raw sales coming out of this one store. And he asked basically two questions. The first one was, do they do high-end furniture or low-end furniture? And he deduced that to be doing those kind of numbers, what would be your guess? This was his guess. They must be doing low-end furniture. They must be doing furniture that everybody could buy, right? Furniture that's available to the 99%, not just to the 1%. Because that's the bigger market, right? If you could sell to the 99%, right? And then the second question he asked is, so their location, is it big or is it small? And he said, with the amount of volume they must be doing, it has to be huge. Without even seeing it, he figured this out, that they're doing, high volume, like lower end furniture, and they're doing it for that mass market. Okay, and he said, and then he started to think more about this business, and he said, well, that's their competitive edge. Because of their size and their scale, they are probably able to get good pricing, right? And if they're going on volume, they could operate on a lower margin. And who could compete with them? A small store couldn't compete. With the size of their store, they must have really good selection that you could go in and take the furniture home today. And you think about a smaller furniture store, often they have limited selection. They're not really trying to sell what's on the floor. You have to order it and wait 8 weeks or whatever. And he just deduced all this from just looking at their sales numbers, and he was right on every count. And he said, and imagine the size of the real estate that they must have to take down and how much it costs them on a monthly basis. Who can compete against that? You'd have to come in and take, as much space, so that it's a high fixed cost business, high barrier to entry. So they basically have a monopoly in the mass market furniture sales in that market. And so they're able to eliminate the competition and maintain their advantage for a long time, because a new entrant would have a lot of difficulty competing against them. And I thought about what he said, and as he was describing it, inevitably came to my mind other businesses that they also own, like Costco. Doesn't Costco do the same thing for furniture and stuff? They sell the stuff that everybody needs, and they sell to everybody, and they have this huge retail footprint that who could copy that, So, and they've owned Costco for decades as well, and it's been a great investment. And it's also an efficiently run business. They have really good operating efficiency, which this furniture place also did. So if they're great operators and they give themselves that competitive advantage, and they create barriers to entry in their business, and you start thinking about other companies that kind of have that similar model that have been great investments, like Home Depot. They do the same thing, but for home building stuff, right? And Walmart basically does the same thing, and Amazon basically does the same thing. Look at the amount of and the size of those warehouses that they have. Who could duplicate that? And they basically own online retail. It's them and everybody else, So these are businesses that have proven to be successful and continue to be for a long time. And there's not a lot of businesses like this that have been able to achieve that kind of dominance in their market. But once they do, it's like a winner take most type of scenario. And these are the companies that they like. They really, when you look at their portfolio, they have a lot of companies that are monopolies or duopolies. And like, we recently bought UPS, and one of the comments Charles made when we were analyzing it was, this feels like a Buffett company. And he was right. And we've been to their annual meeting in Omaha, Nebraska, and I've been a couple of times. Charles goes, I think, every year. And so it's at the Omaha Convention Center, and 40,000 plus people go to hear Warren Buffett and Charlie Munger, rest in peace, speak for about 6 hours. Like 3 hours of prepared remarks and then 3 hours of Q&A. And then on the second floor, or the floor below that, there's like a convention area and a place where different companies have like booths to display their wares and stuff. And these are all the companies, or many of the companies that Berkshire Hathaway owns or invests in. And Charles was right. It was like UPS would fit right in. And they're companies that kind of have those same characteristics that we just talked about. Like fruit of the loom, right? It's something that everybody needs and everybody could afford, right? They have a market that it's that same the 99% of Americans, businesses that sell to that, Dairy Queen, and then there's this, they have a mobile home place, they have a tennis shoe place, Dilly Bars, and Oscar Mayer Wieners, which is part of Kraft, and so they have, and they have this, I think it's Pilot gas stations, right? That are, all of America is their customer, and they have scale, and they have size, and they're just this cash generator, right? Long-term cash generator. So if you look inside of our portfolio, you know, several of the companies that we have would fit that criteria, like Amazon. Google is another one that everybody in the world is potentially their customer. Apple, Facebook, and it's a winner take most. Once they got in there, you know, who's really going to compete? It's almost a monopoly. So they really like those monopolistic companies. Because a monopoly company has the ability, it's not a competitor can't come in and take away their advantage. You know, if you sold wheat, for example, well, the guy next to you is selling the exact same thing, and if his price was a penny lower than yours, he'd take all your business because it's the exact same thing, you know. So you might have been enjoying a nice profit margin, but it's very easy for someone to come in and compete against you and take away your business, right? A monopoly is a company that for some reason it has some kind of moat or barrier to entry or durable competitive advantage. Those are all words that different people use to describe the same thing. A monopolistic power to keep the competitors out and enjoy above market profits for a long period of time. So that's just one thing that we look for in a company, that, you know, once we find one like that, we could buy it and hold it for a long time. I think, you know, we've had mixed results with Nike recently, but fundamentally they have that. They sell a product that everyone could own, and especially in even if it's a little bit of a premium product, you go even to the less affluent neighborhoods, and it's even more prevalent there, and someone can make the exact same shoe, but without the swoosh they couldn't command the same price. That swoosh on their product, on their shoe or sock or shorts or shirt or jacket or pant, right, allows them to charge a premium. They have that brand, and a competitor can make this exact same thing, but without that swoosh, it's not going to sell as much. So, you know, Nike's that type of company as well. Airbnb is one that has kind of captured their market as well. Kind of winner take most. Uber, you know, once they're the first ones in, they have more drivers, so they're more convenient. So if you're looking for a place to work, you'd rather work there. And if you're looking for a ride, if you're the consumer, you'd prefer them because of their scale, right? They're everywhere, and the driver will get more business from them. Same thing with Airbnb. There's probably other places where you could host your property, but you'll get more customers there. And if you're looking for a place to stay, you'll have more selection at Airbnb. So they have what they call a network effects and a durable competitive advantage. So, and if you kind of look through, your portfolio and you ask yourself, is this why Jonathan bought that? You know, and you ask yourself about each of those companies, because mostly we own large companies that you're probably familiar with. And I think you'll be able to deduce for yourself that, oh my gosh, he's right. It does have that similar characteristics to that furniture store that he was talking about. So we just wanted to give you a little bit of insight into what we look for. We don't want to give away all our secrets, but give you a comfort zone that, you know, there's a method to our madness and a reason why we buy these things and why we aren't too overly concerned if it's been a little bit flat for a few months, or you know, is it lightened up? Is it just shooting straight up? Because over time it should compound pretty nicely without us having to do a lot. And that's the thing about Warren Buffett. He's become, you know, one of the richest guys in the world and stayed that way for 50 years. And not really running companies, just identifying them and buying them and holding on to them. So we like that strategy. I think it suits our clients well for what their purposes are, to compound their wealth over time so that they could enjoy a comfortable retirement and leave a legacy to their heirs. So we'll talk more about strategy in the next video, but just wanted to leave you with that. Hope you enjoyed the scenery and hope you have a great day.